Welcome back to the channel. This is Growing Wealth, and we are back with another week of the options portfolio management. There's a lot of things that has been going on in this week. From the SPY, you can see that prices have broke down through all the moving averages ever since we last saw it up in this ascending triangle over here. And right now, the likely price target for the SPY is going to be at the 321 level. At this level, we have saw prices being resisted once and then turn into a support and then support another time. So this is likely going to be another strong level of support where prices may come down, test, and show a rebound afterwards. And what's more, next week will be the election week. So the volatility is going to be very high, and the options for next week's expiration are all very rich in premium. So with the breakdown of prices, many of the opportunities that I've previously spotted and uploaded in the November trade ideas is going to become more attractive as prices dip lower. So do watch the video if you have not. Links will be in the description below, and find the best trade idea that suits your own trading style and personality. Right, and as I've said, we have a lot going on today. Apple has just released earnings. So if you recall, Apple is one of our leap calendar position in the options portfolio. In fact, its result was not that bad. Estimated earnings was 0.619 cents per share, and they did achieve actually 73 cents per share. So that is a good result. But prices still gap down and fall after they have released their earnings. Why is that so? So I think this is likely because of the fact that they did not release guidance, right, for their future earnings. So as we all know, market, they do not like uncertainty. So if they do not release any guidance on their future earnings, this will raise up the level of uncertainty in terms of how they are going to perform into the future and their growth aspects and so on. So that is my reasoning for prices reacting negatively after they have reported their earnings. With that, let's take a look at our position. So like the previous weeks, I've entered most of my positions already. This is the Apple short call that we are looking at over here. So Apple expiring 30 October with a strike of 118. This call, we have sold it last week for a premium of $2.37. And I still remember saying that even though we have earnings this week, I'm still going to sell this 118 call to protect my position. In case of a gap down, at least I can get away with some premium to offset the loss in the long leap call. Right, and that happens to be true. So right now, this short call is likely going to expire worthless. It is currently only going for 15 cents, and Apple is trading at $109 and almost 50 cents. Right, and ever since the fall in prices for Apple, our long leap call has started to show a loss. So our trade price was at 25.91. Right now, market price is only going for 21 or $22. So there is a slight loss of $391 in total. But let's not forget, this is before we account for all the previous premiums that we have collected. So if you take those into account, we are still at a pretty good shape. So this is my trade log for the position. If I were to assume that our short call expire worthless, this is the actual discounted price of our leap call right now, $18.37. Much lower than what you see being reported under the Think or Swim portfolio itself. So overall, this position is still good to go, just that things will get a little tricky from here on. And what I've done earlier today was to sell next week's expiration at a strike of 115. And I've sold this for $1.15, which translates to $115. Just nice enough to purchase one share at the strike price. So after I sold this call, prices went down even lower. Right now, it's only currently trading at $1.06. So if we go over to the option chain, this is what we are seeing. So as expected, because election day is next week, so the volatility for next week's options are all sky high, right? It's at 52%. With that comes rich premium in the option, and with that comes the rich premium in the option. Now we look at 115, right? So the option that I've sold is over here at 115. So it is quite out of the money, and it only has a delta of 0.24, or slightly higher when I entered it. If you are curious, why is the reason I do not want to sell nearer into the money to collect more premium? The main reason is because when you are doing a calendar trade, you want to avoid selling a strike that is below the strike of your long call. So my long leap call has a strike of 115. So whenever I sell a short call against it to earn premium, I want to sell minimum at 115 and not below it. Alright, if you were to sell any of the strike below your long call, and if the sold call were to get into the money, the amount of loss that you have incurred will be much larger, and it will be more tricky and troublesome for you to roll that call out into a profit. More of these risk managements of calendar spreads will be discussed in the calendar spread option strategy tutorial. If you'd like to see that strategy tutorial being released as soon as possible onto the channel, do show your support by smashing the like and subscribe button. Alright, so that is with Apple. And next, along with today's expiration, we have Bank of America. So one of them at 23.5 strike put, sold it for a premium of 80 cents. Right now, Bank of America is going for 23.46. So just teetering around at the money of the strike that we have sold. This is a little bit tricky. I'll be rolling this out into the next month's expiration instead. Along with that, we actually have another Bank of America short put that I've already wrote beforehand, and you can see it over here. Right, so that was the Bank of America 25 strike put that we have sold previously. And I've rolled it out into the 27th November expiry with a strike of 24.5. And for this, we collected a net premium of $23 or 23 cents per contract. And you can see that option is over here. So Bank of America 27 November, 24 strike, 1.67 as the premium collected. So if we go over to the chart quickly, right now Bank of America is somewhat in a consolidation. You can argue that this current level may be somewhat of a good support. It has supported prices previously and the second time and coming the third time, right? Alright, so this level is the 23.1, and if not this level, then the next one will be the 22.7 or the $22 level. So this one was respected way back, and that was in like 2017 and 2018. Nonetheless, I'm still going to roll out our options. So 23.5 put, I'm going to buy it back. And along with that, we'll be selling again the 27 November, and let's do it at a strike of 23. Right, and for this, we'll be collecting 77 cents of credit. So let's just wait for it to be filled. And meanwhile, our last position will be Appv. So this is one of the dividend capture strategy that I've entered for this stock. And for that, we have sold a call at 87.5 strike, collecting a premium of 48 cents. So this call is sold against my stock position at V of 100 shares. I entered this at a trade price of 88.4. But if we take into account all the premiums that we have collected, our effective discounted price is actually 87.5. And if we factor in further these 48 cents collected, this brings our effective discounted price to now $87. And what I've done is to sell next week's expiration, 6 November, at a strike of 87. So for this, I've collected 150 in premium. All right, so let's go over to the option chain. So previously, I've mentioned that our effective discounted price is at $87, right? Now, there are a few ways you can do this if you're in my position for Appv. There will be two approaches to this. One of them is the normal approach, which is what I've done to sell a call option at the strike of my discounted price, and that is $87, right? And I've collected the necessary premium with it. Another approach would be the more conservative way. Basically, you want to sell another option that is closer to the money. Let's say we can maybe target the 85 strike. If you sell the 85 strike, let's say for a premium of $2, now if you add that on to your strike price, where is your break even? Your break even will be 85 plus 2, and that will bring it up to 87. So when you select this option, essentially what you are saying is that as long as the prices of Appv went up to $85, I'm going to offload my shares. I'm going to get out of my stock position as fast and easy as possible, grab all the premium, and then effectively I'm exiting at $87, which is my effective discounted price. And in fact, this will not be that difficult because Appv is currently just a few cents away from hitting this $85 strike price. Right now, Appv is trading at 84.15, right? So this is the more conservative way. All you need is for Appv to rally a little bit by the end of next week to reach 85 strike, and then you will be able to get out safely. And if Appv does not rally for you to exit, and in fact it drops further down, then at least you have collected a greater amount of premium to offset your effective discounted price. So if you have sold at $2, your effective discounted price of the shares will further drop from $87 to now only $85, right? And then next week, you will just rinse and repeat. You can maybe sell the 84 strike or the 84.5 strike, right? So this is the more conservative approach. Which one you choose depends on your personality and the style you want to manage your positions. Now, if we go over to the charts of Appv quickly, Appv has also just released earnings. So in fact, they did quite well. Estimated was $2.75 per share, and they did a $2.83, right? So slightly beat the estimate, along with other factors that resulted in share prices gapping up strongly after earnings report. So we are just lucky that these earnings work in our favor. Even though prices have gapped up, right now we are still seeing that prices seems to be resisted by the 20 EMA in the red dotted line. Right, so whether prices will have another correction back downwards, that remains to be seen. Okay, so once again, we have seen the power of earnings, the unpredictability of earnings, and what it can do to stock prices. So please, if you are trading and do not have the strong holding power, and especially if you are leveraging, do not hold your positions over earnings. All right. So that's a very dangerous to do. That's a very dangerous thing to do. And if things goes wrong, it can be very devastating to your portfolio. All right, so that's basically all I want to cover for this week's options portfolio management. All we need to do is to adjust and get this Bank of America put rolled out. For Appv, I'm just going to leave it expire, worthless. That shouldn't be a problem. And the same for Apple, it's going to expire worthless. So I'm not going to do anything and just leave it there. And for next week, once again, we will have the 6th November. Wow, such a long list. So this time, we have the usual trio, the Apple, Bank of America, and Appv. And in addition to that, we will have the EEM covered calls and FXI covered calls. If you take a quick look, FXI is currently going for $44 against my sold call of 43.5, so not that deep in the money yet, so not much action needed. And EEM is currently going for 44.5. EEM is out of the money already, in fact, right? So hopefully EEM stays low and these two calls can expire smoothly out of the money. Right, so before we end off the video, I'm just going to adjust my trade for my Bank of America. As you have seen from all our previous episodes, if you can do this very smoothly, it can be a very lucrative weekly income for your portfolio. If you have any questions regarding how the trades are being managed, feel free to drop them down in the comments below. Alright, and it's filled. Thank you so much for watching. I'll see you in the next video.